Everybody, this is the second lecture for today. Okay, so this is still on topic 1. Now the section is about primary users of financial reporting information. So I just want to refresh your memory. The first thing that I have explained in this topic is the definition of accounting. Okay, the simple definition of accounting is a process to analyze and record business transactions and to report financial information. And then I have told you the financial information is the output of the financial accounting. So that information is called financial statement. I have told you that every business has to produce a financial statement at least once a year. In the financial statement, there are 5 components: income statement, balance sheet, and 3 other components. The focus of this course is on the income statement and balance sheet. And then I told you also, for companies like AirAsia, Petronas, Alibaba, Amazon, what else? There are many companies out there in Malaysia and also in other countries. All companies have to prepare the financial statement, also have to publish or show the financial statement to everybody. Okay. And then, okay, this is the next thing. The people who use financial statement are called user of financial statement or accounting user, or sometimes they are called user of financial reporting information. Okay, just to say it again. The output of financial statement is, the output of financial accounting is financial statement. People who use the financial statement are called user of financial reporting information, or sometimes we call them accounting user or user of accounting information, etc. Okay, so there are 2 groups of user of accounting information. The first group is called internal user. So the thing is like this. There is a business. The business has to produce financial statement every year. In the financial statement, you can see income statement, balance sheet, etc. Who will use this financial statement? There are 2 group of users. The first one is internal user. Internal user, basically the management of the business. The management of the business use the financial information to make business decision. The management of the business will see the income statement, the balance sheet of the business, and the statement of cash flow, etc. for the purpose of doing business decision. They will decide whether to sell more, or to increase the price or decrease the price, that kind of business decision. To open new branch of business or to close down a branch of business. A manager has to make many business decisions every day. They will use income statement or accounting data or accounting information to make business decision. Okay, so that is first group of user. The second group of user, or the second group of user of financial statement, is called external users. External users are people who use financial statement information, but they are outside the business. The first example of external user of financial statement is investor. For companies, this is for companies because companies has to publish or release their financial statement to the public. Companies, they sell shares. If you want to invest in company shares, you can. You register, you open an account. In Malaysia, you have to open an account. You have to hire a remiser or stockbroker, and then you can buy shares of companies. In Malaysia, company shares are listed in Bursa Malaysia. Okay, so investor, before they decide about to purchase shares or to sell shares or to keep shares, one of the thing that they will do is they will read the financial statement. Basically, if a business is a good business, then investors will purchase shares. So how to know the business is good or not? By reading or by seeing the financial statement of the business. So investors use financial statement to make investment decision. They want to decide whether to purchase shares or to sell shares or to keep shares. Every financial statement user has their own purpose. Like earlier, I mentioned that manager, they are internal users. They use financial statement to make business decision. Investor are people outside the business. They also use financial statement produced by a company. Why they use the financial statement? They use the financial statement to make investment decision, to decide whether to purchase shares or not, to sell shares or not, to keep shares or not. Okay. And lenders, the second example of external users is lenders. Lenders are institutions or parties who lend money to a business. So why lenders use financial statement? Lenders are like banks and financial institutions. They use financial statement, or they read financial statement, or they see the financial statement to make lending decision. Lending decision means to give loan or not to give loan. So the thing is like this. If the basic idea is like this. Most of the time, a company will have to borrow money from bank or financial institution. So before when they want to borrow money from bank or financial institution, most of the time, the bank and financial institution or the lenders will ask the company to submit a financial statement, because the bank and financial institution, before they give loan, they want to see the financial statement. If the company has sufficient cash to pay back the loan, then the bank or financial institution will give the loan. If the bank or financial institution see that the business has no sufficient cash to pay back the loan, then the bank will not give the loan. So lenders, which are banks and financial institutions, they use financial statement, or they read or they see financial statement of a company because they they want to make they want to make lending decision. Lending decision means to give loan or not to give loan. Okay, this the third example of external user of financial statement. The third example is creditors. Creditors are parties that give credit to a business. Let's say in the future you have a grocery shop. So now we use a company example. Let's say you have a supermarket business in the future, and then the business is a company. So most of the time when you want to purchase inventories or stock, you want to purchase in credit. Many businesses out there, they purchase in credit. They take the inventories or stock first. Later, after 2 weeks, they pay the cash. That is the credit transaction. So the parties or the supplier who gives credit, we call them creditors. Creditors, they also a user of financial statement. Before they give credit to a business, most of the time they will ask the business to submit or to give them the financial statement. They will see. A creditor will see the financial statement of a business. If the creditor sees that the business has sufficient cash to pay in the future, then the creditor will give credit. Otherwise, the creditor will not. Employees. Customer. Okay, employees. A big company. Let's say we make an example. AirAsia. AirAsia is a big company. Every year, AirAsia will publish their financial statement. Employees of the AirAsia is one group of financial statement user. After AirAsia publish their financial statement, employees are interested to use or to see or to read the financial statement. Why? Because they want to make employment decision. The employee, if they see that the business or the company is making profit for many years, then the employee will decide to continue working in the company. But if the employee see the financial statement and found that the business is making loss this year and in the future maybe the business will make loss again, then the employee will decide to find a job in other places. So employees will use a financial statement to make employment decision. And then customers. Customers are also will use financial statement. Most of the time, if a customer want to purchase expensive item that comes with warranty. Let's say there is a customer. He wants to purchase a machine, very expensive machine that comes with 5-year warranty. The customer has or should see or use financial statement of the company that sells the machine. The thing is like this. The machine comes with 5 years warranty. So the customer has to see whether the company is that sells the machine is good or not. The customer has to see whether the company can survive in next 5 years. Because if the company can survive in the next 5 years, then it is a good idea to purchase the machine because the company can honor the warranty. But if the customer see that the machine comes with 5 years warranty, but when the customer found that from seeing the financial statement, the company that sells the machine is a trouble company. It's a trouble company. Maybe the company will collapse next year, will bankrupt next year. So then the customer should not purchase the machine, because if the company collapse or bankrupt, then there is nobody can honor the warranty. The warranty says 5 years, but after 1 year purchase of the machine, the company bankrupt. So the customer cannot claim the warranty if anything happen. So that is how a customer also can be a user of financial statement. Okay, government also use financial statement to set tax. If government sees that many companies are making profit, then the government will maybe increase companies' tax. But let's say in one time, government sees that many companies out there are making loss, then the government maybe will decrease tax, and maybe government will give subsidies. Public, some people in a country or something, in a place, they are interested to see a financial statement of a user. Let's say they see that a company is making many profit, then maybe they will ask for donation and etc. They ask for donation, sponsorship for the community. So public also can be a user of financial statement information. Okay, now I will show you more detail about financial statement. I have told you financial statement is the output of financial accounting process. Every day a business do the recording. At the end of the year, the business has to stop and produce or prepare a financial statement. So what is a financial statement actually? See here, the components of financial statement. Let's say financial accounting reports or output is called financial statement. It provides summarized information to the owner of the business. Okay, financial statement contains 5 components. The first one is balance sheet. The second one is income statement. Number 3, statement of equity. Number 4, cash flow statement. And number 5, notes to the account. Okay, now we are focusing on a sole proprietorship business. Sole proprietorship business is a business owned by one person. The simple example is like a grocery shop. Most grocery shops are owned by one person. They have several workers, but the business is owned by one person. If a business is owned by one person, we call this business as a sole proprietorship business. Another example is maybe laundry shop. Laundry shop is most of the time is a sole proprietorship business. Any business that you see owned by one person, you can call the business a sole proprietorship business or single ownership business. Okay, so let's see. What is an income statement? Income statement is a summary of revenue and expenses for a specific period of time, such as a month or a year. Income statement shows the performance of a business. Income statement shows whether the business is making profit or loss. In accounting, if a business is making profit, we can say that the business is performing well. if a business is making loss, then we say that the business is not performing well. If a business is making loss, then we say that the performance of the business is not good. Okay, this is an example of an income statement. This is income statement for a service business. Very easy. So, like I said earlier, income statement shows whether the business is making profit or loss. So, how to calculate profit? In accounting, to calculate profit, the basic formula is revenue minus expenses. If you have a business, you will have revenue from selling goods or from providing services. So here, see, this is the format of income statement. The revenue is fees earned. Okay, this sample business is a service business. When the business provides service, then the business will charge fees. So that is the revenue. The revenue is fees. And then this business has several expenses. When you run a business, you have expenses. The example here is wages for the workers, rent, supplies, utilities, miscellaneous expenses. Utilities are things like electricity, water, telephone, internet. These are called utilities in accounting. Utilities expense. So in this example, the revenue is 7,500. The total expenses is 4,550. So the net income or profit for the business is $3,050. Okay, this is the format for income statement for a service business. For a merchandising business, like a grocery shop, the income statement is a bit complex because a grocery shop or a merchandising business sells something, but a service business does not sell anything. It provides services only. That's why the income statement is simple. You will see later. This is another example of income statement. This is still income statement for a service business. See, there are revenues. In this example, there are two revenues. Revenues from consulting revenue and from rental. So you can see the total revenue is 6,100 and minus expenses. Revenue minus expenses, you will get net income or net profit. That is the basic formula that we use in accounting. So see, income statement is not difficult, very simple. The format is very simple. This is the statement of owner's equity. Statement of owner's equity shows the increment and decrement of owner's capital in the business. In the later, you will know that in accounting, when you start a business, things that you put into the business are called capital or owner's equity. Let's say you start a grocery shop. You take your own to start the grocery shop. You take your own cash, 50,000 to start the business. That 50,000 is called capital or owner's equity. That 50,000 is owned by you. You invested into the business. Later you will learn about that. This is statement of equity. Remember, the statement of equity shows the increment and decrement of amount owned by the owner of the business in the business. When you invest, when the owner of the business invest something into the business, the owner's equity increase. But when the owner of the business takes something from the business, then that will decrease or reduce the equity. Later you will learn more about that. Okay, our focus is on the income statement and balance sheet. You have seen the income statement, now this is the balance sheet. A balance sheet is a list of asset, liabilities and owner's equity as of a specific date. It shows the financial condition of a business. Okay, remember, balance sheet shows the financial condition of a business. So this is the basic format for balance sheet. in the balance sheet, you have to list all the assets owned by the business, and or in the you have to list the assets in the left side of the balance sheet, and also at the same time you have to list all the liabilities and owner's equity in the right side of the balance sheet. You can see here, in this sample balance sheet, there are assets in the left side of the balance sheet. The assets are cash, supplies, land. Total of the asset is 26,450. Assets are resources owned by the business. If you have a grocery shop, your shop will have many assets, like maybe the building, maybe the equipment, furniture, and also inventories, etc. These are asset. Cash, maybe land also. These are asset. Liabilities are amount. It's like borrowings, amount that a business has to pay in the future. Liabilities, the examples of liabilities are bank loan, account payable. What else? There are these two are the common one, account payable and bank loan. If you have a business, you maybe make a bank loan. That is a liability. Account payable is something like this. You purchase something from supplier, but you will pay in the future. That amount that you will pay in the future, or will have to pay in the future, is recorded in account payable. Something that you will pay in the future. That's a liability. It's like you have to pay something in the future. And then owner's equity are amount related to the contribution of the owner. When you start a business, you, the owner of the business, will have to contribute something. You have to invest cash. Sometimes you use your own building, etc. Okay, this is the format. Later you will learn how to prepare this, to prepare or to make the a balance sheet for a business. This is the second example. The same thing. In the left side of the balance sheet, you have to list all the assets. In the left side of in the right side of the balance sheet, you have to list all the liabilities and equity. Balance sheet has at least another format. Another format, we call it statement format. If you use statement format, you do not have these two columns. You use one column only, but shows but you will show the same thing. You have to show all the assets, all the liabilities and equity. Later we will see that in detail, how to prepare the balance sheet. Today you see the format only, to get an idea what is an income statement and what is a balance sheet. Okay, another component of financial statement is cash flow statement. Cash flow statement shows cash in and cash out that happen to a business in one accounting period. This is like more than in year 2007, or this is an old example. But basically, this is the format of statement of cash flow. It shows that how much cash goes in, how much cash goes out during the year, during the accounting year. So in this example, you can see, hopefully, cash payment, cash receipt. But in this course, the focus is on income statement and balance sheet. You will learn how to prepare income statement and balance sheet for a business. Other than that, you just have to know the basic purpose of that document. For example, for statement of equity, you have to know what is a statement of equity, what is the purpose of the statement of equity. Cash flow statement, what is the purpose of the cash flow statement. And the number 5, the fifth component of financial statement is called the notes to the account. Notes to the account contains explanation and detail about all items that appear in the income statement, balance sheet, statement of equity, and statement of cash flow. Just remember, the most important thing for you, you have to know how to prepare the income statement and balance sheet. Thank you very much. This is the end of lecture 2, week 1, and this is part 2. Next week I will continue with the next subtopic in this, still in topic 1. Do not forget to write your name and matric number in the comment section.